Hey, everybody, good morning, and welcome back to our weekly ship show. My name is Jason Brand, and I'm the Director of Outreach and Partner Development here at Supply Chain Solutions. So, for this week, we've got the freight market roundup. And to start you guys off some sad news, we will not be having Anthony D'Ambrosio on the freight market roundup or weekly ship show anymore. He is just super busy. He is tearing it up right now out in New Jersey. And yeah, we're going to make sure he makes a guest appearance here and there. But going forward, expect our guests we've got planned for the weeks. And then also you're going to be seeing myself for the freight market roundup. But we're also going to try to get this thing out to you as fast as possible. Our goal here is to make this quick, make it digestible. And so, we're going to shoot for around 15 minutes. Both Anthony and myself can be some long-winded folks. So it might take us a few weeks to get to that point, but just, hold on tight. We will get there. Now, as a full gear shift, I am sick right now and I have a cold. So I want to apologize in advance if I am muting and coughing or sneezing or whatever that is. I've Dayquil'd up. I've got plenty of hot tea in a shaker bottle for quick ingestion. So, I've got the means to, keep it under wraps. But just in case, going to let you know. Anyway, let's get this show on the road. We're going to try to make this quick. We're going to try to get all the information we can to you as fast as possible and get you back on with you on Thursday. So let's start this week off talking about, as we generally do in our freight market roundup, our ocean shipping lanes. We're going to start with our Trans-Pacific lane. That specifically we're talking about Southeast Asia, China, coming into the U.S. West Coast ports. We're going to move over to the transatlantic. So we're talking about Europe shipping into the U.S. East Coast ports. And then we're going to chat a little bit about a lane we used to talk about on a regular basis. That is our Southeast Asia and China lane going through the Suez up to Europe. So we'll mention that as well. We'll cover all of that info, only the ocean shipping portion. Make sure if you're comparing your costs and things like that, you're understanding we're not talking about inland. We're talking about just ocean. But truthfully, bust your invoices out because this is going to be very helpful. And then after that, we're going to talk about the air freight market and we're going to wrap it up for today. So also, I'm going to do all the rates right in the beginning. So just kind of get ready to build a mental image around what's going on in the markets. And every once in a while, we'll do kind of a run through of, hey, what's happened during this lane over the course of this year? Where was it last year? What to expect in the next 6 months based on these trends? So more of that in the future. Anyway, let's get going. As I mentioned, Trans-Pacific first, Southeast Asia, China into the U.S. West Coast. So looking at our last week numbers, the average cost of our shipments traversing the Pacific came down to roughly $3,200. Now, our lowest price shipments across all the carriers and all of the origins that we booked was right around $2,900 per container. And this is a 40-foot container. But the most expensive was around $3,600. So we had a technically $3,220 average, lowest at $2,900 and most expensive at right under $3,600. Definitely give us a call if you're out of this range because we would love to help you and, make sure we know what's going on with your shipments. Now, next up, let's talk about the transatlantic. In particular, remember, we're talking about leaving those European ports and heading into the U.S. East Coast. Now, this is actually a little bit of an interesting lane. If we go back to the first week of April, we, SES, started to see some upward movement in the transatlantic shipping costs. And, obviously the situation at the Port of Baltimore did factor into the increase, and that was something we had to factor. But what we were seeing was something that seemed to be a little bit bigger. And while our average has actually remained pretty reasonable for the time being, we're definitely starting to see some signs that this lane is going to be increasing in price over the next few weeks. So in particular, we're noticing that some origins didn't rebound as well as they normally do. So generally speaking, after like a GRI, for example, the rates will drop back down around where their normal levels were. But if they don't, that tends to be an indication that there's more demand. And that we did see in some locations. So with all that in mind, our average, the customers of ours paid for a 40-foot container crossing the Atlantic was roughly $2,100. Now, our most expensive shipments have sharply increased in comparison because actually $2,100 is pretty good compared to what we've been able to get actually over the course of this month. But the most expensive shipments we had were all the way up there at $3,500. So for that lane, that's a pretty big increase. And our cheapest shipments also aren't as cheap as they used to be. Now, across all origins, across all carriers, we were seeing right around the lowest point at around 2,000. So this seems to be, as you kind of look at like the scope, that's really moving up. We're still capturing a lower average, but probably not for long. Now, this is not just us. I ran through a bunch of analyst reports. I talked to my team as well. In general, we're thinking that we're going to be seeing these rates increasing, or at least staying the same at a higher point for at least the next few months, if not throughout the year. So keep that in mind if you're shipping the lane right now. And finally, I did want to talk a little bit about Southeast Asia, China to Europe, that lane. It's been very tough to break down this lane accurately. And the reason why is, there's a conflict going on in the region, and, some carriers are able to get through, some are not going through at all, some are going around Africa. So we've got a situation here where the consistency of the shipping cost is a little bit up in the air. Now, I'm sure you've heard that there's been more things going on. Obviously, over the weekend, we had the Iran attack that happened. But, I'm sure you heard about that, but possibly you did not hear about what happened in the Straits of Hormuz. That was a Portuguese flagged container ship. It was the MSC Aries. It was actually seized by Iran, and Iranian authorities went on to say that, they could, if they wanted to, close that entire strait for shipping if they deemed it necessary. So my question is, why is this important? Why should this concern you? And really, the reason is there's a huge volume of oil that is transported right through 3 choke points around the Arabian Peninsula. The Straits of Hormuz is one of them. The other 2 are the Straits of Bab al-Mandeb. And finally, which we've been talking about a ton, the third is the Suez Canal. So between these 3 choke points, more than half of the total crude oil that is shipped by vessel passes through. So a disruption in this region, particularly we're talking about right now, the Straits of Hormuz, will have a very long-lasting effect on supply and demand prices or supply and demand in the oil markets, and that will, reflect oil prices. So make sure you keep that in mind. That just happened. This could be a situation that unfolds. I mean, if we've kind of looked at fuel costs in the past across the board, and I'm not going to be talking about this today, but in general, fuel costs have been relatively stable recently. But that could change if this situation does develop. So keep that in mind. Now, other things that are going on, and we've got some major stuff, and actually there's a lot of stuff, so I'm going to try to keep it short. But the Port of Portland actually announced they're no longer going to be having a container service as of October. And the Port Authority said that they could no longer offset these growing financial losses, and they were trying to find a third-party operator to permanently take over, but they were unable to. So this announcement, actually, if you've been watching their financials, has been seen for some time now. Really, in 2023, they had a $13.2 million loss. And then when we just look at the start of 2024, they had an even bigger loss, a $13.7 million loss. So this is definitely a long time coming. If you look at their volumes between July of last year and February of this year, they saw 43% less as far as containers handled during that time period. So that's pretty big. And, obviously, if you use the port, of Portland, it's got its intricacies and it's got its ways of working. It's not the largest port, but it still is a significant port. It's a port that we use on occasion. And, from a supply chain standpoint, losing an option is always not a good thing. Obviously, we have more power when we have more options for you, and we have more control of how to best serve you in that case. We can tap into different markets at different times. It's a great way to avoid disruption. So it's painful when we see a port in general cease operations such as this. And remember, this is not the entire operations. This is the container shipping operations. Now, this is kind of interesting because it's happening in a situation where we're seeing very conflicting data. On one hand, imports in particular to the U.S. West Coast have been seeing these record-breaking increases. And on the other hand, you just saw this 43% decrease up to February of this year in containers handled by the Port of Portland. Now, I want to dive into that increase in imports, though. So U.S. retailers on April 9th, they upgraded their first half import expectations for the third row in a month. So they're predicting that volumes will be 11% higher than the comparable 6 months in 2023. So it has been a very promising year so far, and them doing that is actually pretty big news. What we also saw, if we're kind of looking in retrospect, January, U.S. imports from Asia were up almost 40% from February 2023, and that is following an 18% year-over-year jump that happened in January. Now, these numbers sound phenomenal. Apologies, I'm going to take a Sip of my shooken tea. Now, these numbers, they sound phenomenal. You do have to remember we're still getting back to a normalcy after the pandemic. So these big numbers don't really equate to big growth, so to speak. But what we are seeing is obviously imports that will lead to stabilization, and we need a steady amount of flow, not growing rapidly or shrinking rapidly, to have stable supply chains. That's really the crucial thing here. Now, I want to kind of look at the flip side of this again. So we obviously have the Port of Portland, which is going to be ceasing container operations. We have this huge increase into the US West Coast of Asian imports happening between January, February, and March. The numbers, we're kind of getting a little teased at them, but I'll talk about those later. Then on the flip side, you've got the trucking market, which has actually been very flat during all of this. So J.B. Hunt had an earnings call just last Tuesday, and they said quite a lot of things that were very, very interesting when looking at this data through this view. So what they said specifically were their volumes were flat for the quarter for the entire J.B. Hunt network, except for their incoming Southern California volume, which did grow by double digits over Q1. Now, when you really dive into the numbers that they're reporting, you can see that the gains they're seeing in California's inbounds are really making up for losses elsewhere, and not even completely. So, for example, J.B. Hunt's transactional or transcontinental intermodal rail volumes did increase by 5% year over year for the quarter. But when you zoom into it and you look at the data, you actually see there was a 7% decline in all of their Eastern network year over year. So 5% increase for the quarter, but we had a 7% decrease on the Eastern half of their network. And the bottom line of the call really set the tone for the trucking sector. So I want to quote Darren Field, it's J.B. Hunt's president of intermodal. And he said, while imports into the U.S. West Coast have improved and inventories are in a more balanced position, we, being J.B. Hunt, have yet to see that translate into any meaningful pickup in demand. So that statement was really underscored by their financial performance, which the company's overall intermodal revenue dropped by 9% year over year to $1.4 billion. And the intermodal division's operating profit fell by a massive 40%, which ultimately clocked in at $101.9 million. So, we are seeing two sides of the equation. Obviously, more imports in general are needed to support just stability. But that being said, just be careful when you see these numbers that you're not tricked into us being in a better situation than we are at this current moment. Now, there's a lot going on. Honestly, there's so much happening at the moment. And quite frankly, every year, really post-pandemic, every year, we have a lot we've got to cover. But I want to switch gears. I want to talk about the air freight market. There's a lot happening here and a lot we got to talk about. So, unfortunately, I do have some bad news. If your business model does rely on air freight, and if it's specifically relying on air freight coming out of Southeast Asia and China, you are going to have a tough year in terms of shipping costs. And I've got a couple reasons why I want to break down, but right now our customers are paying an average of $6.55 a kilo to airship into the US from Southeast Asia and China. And that's across all origins. From all origins, we're seeing a low of $6.15 a kilo and a high of $1 more, $7.15 a kilo. And these are incredibly high costs, but they're likely to rise. And we've covered a lot of the reasons why these have been a little bit higher than usual and some of the disruption the air freight market has been through. But there was some interesting data that just came out that talked about a couple companies that may be making it harder for anyone else air shipping out of this region for the time being and for the foreseeable future. So 2 e-commerce companies. And I'd love to put a poll out because I'd love to see if you know what these companies are. But, we don't have time for that. And also we don't do that. So here's what it is. Temu and Shein. Temu was founded back in 2022. You've probably seen it. It's the orange app. It's a basically direct from China marketplace. And both of the companies, Shein included, ship basically exclusively air, almost 100% out of China. And it's estimated that they ship roughly 6,000 tons of product a week, which actually fills 60 air freighters weekly. So, and all of these shipments are headed exclusively to the US and Europe out of China. So air freight rates a little bit high out of China. We've got a couple companies doing pretty well exclusively air freighting that are sucking up a lot of capacity. Now, they aren't the only big shippers in the business that are only air freighting. And obviously e-commerce has been doing particularly well and actually getting better recently. it is expected that just this year alone, air cargo demand is going to increase by 4.5%. And that number is already outpacing capacity. So we already are having an issue when we look at, right, the cheapest air freight we were getting as of this week was $6.15 a kilo into the US. The most expensive was $7.15. And our growth expectations are saying that's going to get worse. Now, on the flip side, we've got a situation with our freighters. So we have 650 air cargo freighters. Obviously, those are just exclusively air cargo. Those are dedicated to China, US, Europe. Now, what we've got going on is some air cargo does go in the belly of passenger planes, but we're back to a point where passenger planes are back in regular rotation. So the situation where that was off the table because of the pandemic it's fixed. The new issue we are looking at is the aging out of some of these old planes. So we've got 650 in rotation, and 120 of those air freighters are over 30 years old. And that is right about the life of these air freighters where they're taken out of service. What we don't have is an order book for new air freighters that's equivalent to the 120 we're going to be losing here in the next 24 months. So if you rely on air freight, I really have to warn you, there is a moment of capacity crunch, which will be happening here in the next 24 months. And it really is determined on when these 120 air freighters that are over 30 years of age right now are taken out of service, and it will be happening soon. So keep that in mind. And obviously we do have this air cargo demand growth. You know, what's happening right now, the market has a way of righting itself. So I'm going to end it right there because I don't want to make any statements like that. Anyway, guys, we tried to get this show out to you as fast as possible today. Looking like we're right around 16 minutes and 45 seconds. I really appreciate you guys joining. Make sure you make it a great week and let us know if there's any area you want us to talk about in particular. We've got a lot of really big hitting things happening that are affecting our customers right now. So we might have to get in the habit of sending out a little post-show recap of some of the stuff we aren't able to cover, but we'll talk about that in the future. Anyway, thank you all so much for joining today, and I will catch you guys next week. Bye.